Welcome, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you as a reference point. We expect you to form your own financial opinions and make your own financial decisions. Today is Sunday, April 18th, 2021, and this is Blockhead Traders Weekly. This week, I myself, Sprocket888, am joined by fellow Blockhead trader Viper XL007 in this week's episode of Blockhead Traders Weekly. Last week, earnings kicked off here on the market. And this week, we thought we'd take a dip into what exactly are earnings, talk a little bit about them, and how it might relate to premium sellers, option buyers, and things of that nature. But before we do, I want to put a plug out there for the Discord channel. Just a reminder that in the link in the description below, we have our Blockhead Traders Discord room that is free and open to everybody. We have a couple of chat rooms in there. You can hop on there, ask a question directly to myself or any of the other traders that happen to be hanging out there in the day. There's usually plenty of traders in there during the market. A few of us hang out there after hours, and we'd love to say hello and learn a little bit about you and hopefully answer some questions for you. So, earnings. What are earnings? Earnings are an event that happen about 4 times a year for every company that is publicly traded. And it is when they take the most recent quarter and roll it up to their investors and report out both the performance of the company over the past quarter, as well as guidance moving forward into the next quarter and the remainder of the year. Earnings are a particularly volatile time. And a couple things to note when companies report earnings, that industries will tend to move together based on other earnings. So if you're in the retail space and Walmart happens to be reporting, whether Walmart reports good, bad, indifferent type of earnings, you can be rest assured that that's going to drive a movement in its closest competitors' prices. Target, or any of those other large retailers. So be cautious of this. If you happen to hold any options or shares of a company, just know that always pay attention to that earnings date and when somebody is going to be reporting from their industry as well as their own report. As premium sellers, we always talk about different deltas and probability of profit. We're going to talk about a couple of different earnings trades today for the upcoming week for companies that report earnings. But when it really comes down to it, earnings are a real coin flip. So you can look at all the different option spreads and the different odds and probabilities, and chances are whatever you put on there, you probably have about a 50-50 shot at landing something to it profitable for earnings, despite of what the probability of profit actually says. I want to call out the high IV because I think it's super important to recognize this. What I want to kind of do real quick is just kind of pull up a chart here on a company that's going to be reporting earnings this week. It's a chart for Snap, but there is this line down here. This is the implied volatility, and what I want you to see, earnings are, I think, this Thursday, Wednesday or Thursday of this week. I'll double check in a bit, but what you can see is the implied volatility has kind of climbed as we approach this week of trading. And this is super important to recognize because a lot of people think, oh, you know what I'm going to do? I'm going to go out and I'm going to go buy some calls because maybe you're really bullish on Snap, or maybe you're really bearish and you want to buy some puts. Just be cautious of this elevated implied volatility because that's one of the largest drivers of premium price. And what's going to happen is as soon as those earnings are released, that volatility for the near term is just going to evaporate away. And it's just going to fall real fast. So you're going to be paying an elevated price going into earnings if you are buying options. So a lot of times what you'll see is people that like to buy options for earnings, they would try to put their purchases of options, maybe multiple weeks prior to earnings when that premium is a little bit lower and not inflated because of the upcoming earnings announcement. So as a premium seller, this is one of the best times to hop in earnings. And I have to admit, earnings plays are super fun to play. But I caution you, they really are a coin flip. I can tell you that in the past 2 years of trading, I've played a lot of earnings, and my largest gains come from earnings, and my largest losses also come from earnings. So it is really a 50-50 shot when it comes to how the earnings are going to play out. But it can be really fun because that volatility contraction really happens overnight. So when I play earnings as a premium seller, I would put a trade on the day before the earnings, or basically the last chance I have before the earnings are announced. If they're an after the bell, I'll put them on the day of the earnings. If they're before the market opens the following day, I'll put them on while the market's open the day before. And basically, as soon as those earnings come out, when the market opens the next time, that volatility is just going to drop like a rock. And, you can get in and out of trades really fast. And so as a premium seller, you can throw a trade on there, and you can be pulling in profits, considerable profits within 24 hours. And because earnings all get clumped together for about a 3-week period, 4 times a year, you can really cycle through earnings again and again and again. So you can take those profits, get your buying power back, and play the next company the next day, and rinse and repeat over and over and over again. I'm going to show a couple examples of how volatility really changes. Let me just pull this up real quick. Let's take a look back here at Snap. And what I want you to notice here, actually my head is in the way. Let me move that over.
Blockhead.
Yeah, right there. What you see here is the option chain for Snap, and Snap actually has weekly options, and they report this week. So the options that expire on April 23rd basically contain the earnings announcement. And look at the volatility. They have 153% volatility. Whereas, if you look out about 3 months, 2, 3, 4 months, you're probably running around a 60 to 70% volatility. So you can see that it's just super elevated coming into this earnings announcement. And what you're going to see after earnings come out is you're going to see a ton of volatility drop out of the April 23rd. You'll see a good bit drop out of the 30th April expirations, but not as much as the 23rd. And the farther down you go in expiration, the less and less volatility drop. So a lot of times, if you want the most volatility bang, you're going to be playing the earnings the week of expiration. So for this particular example, you would want to be selling the April 23rd options if you wanted to get the most out of the premium. So before I pull up a couple of the trades there, we'll see if, Mike, do you have any thoughts on earnings? Do you ever play earnings as options, or maybe after hours, or trading shares or anything like that?
Yeah, not too significantly. I mean, a couple earnings seasons when you were getting into it, I jumped in mostly open shares for some positions at that time. Though I would like to do some more of the options and premium selling. But really at this point, the only reason I haven't is just because it hasn't, I'm usually too busy in other plays that I don't have the spare resources to devote to it. But there is very much, like you said, it's a game. I mean, there's a lot of, I don't want to say fundamentals, but there's a lot of thought that you can put into it. So it's, it's not, maybe it's an oversimplification to say it's a game, but at the same time, just the way things move. I mean, you get, I've consistently on a particular company, been like, this is the moment, this, like, everything's good, earnings are nailed, fundamentals are nailed, and all of a sudden, plop, it just drops like a rock. For no explanation other than maybe some huge large hedge fund or somebody didn't see what they wanted to see, so they bailed, and it just gave everybody else a great sale, and then it ends up bouncing back up or whatever. So so it is fun from that perspective of, not devoting a significant portion of your portfolio, but a portion that you're willing to gamble with, and make a smart throw on the craps table, I guess, as smart as a throw on a craps table can be.
Yeah, that's actually a great point. I mentioned it can be a 50-50 shot, and I just want to reiterate that because there are times when, I put my earnings trade on. I was super bullish, thinking a company is going to beat on both profit as well as revenue, and then put great guidance going forward. And that's happened in some plays where everything is lined up. They beat the earnings, they beat the revenue, they gave great guidance, and the stock dropped 10%. And it's really, I don't care how good you are. I don't care what information you have. You don't know. Earnings are 50-50, really, when it comes down to it. You'll either win or lose.
And
so as long as you know that going in, and play it, you'll be in good shape.
And it can be, one thing that can give you a little guidance. So I would not recommend gambling in earnings without at least having an idea of where something could go one way or the other. Meaning, so at least chart some levels on a chart just to know, like, if this thing goes south. Levels are always respected. Obviously, the caveat to that is you don't know how many levels are going to be crossed. That's the CYA statement for suggesting levels is, you don't know exactly where they're going to stop. Where it's going to stop, which level it's going to stop at. But it is good to know where the levels are at, because sometimes it could be very clear of, like, okay, this is a major level. There's 2 levels to get there. So, okay, I'm feeling pretty good. It's not going to cross this 3rd level away or something like that. And you can be a little more protected. But you could also, on the flip side, not place a play, and you could place a play in reaction. Like if it's open shares or something. So like we said, earnings that surprise, where everything's beat, everything, watch the after hours. And if it takes a huge dive, consider if that's a buying opportunity for you, if you want to go open shares on it. Because that's certainly a place. That's another way you could react, is wait till after their earnings, see if it was an overreaction, and then find a way to capitalize on that.
Yeah. So let's take a look at some of these possible earnings plays for this upcoming week here this week. And what you see on my screen here, this is my earnings play screener that I utilize. You can come into the calendar here, which basically show you a lot of economic events, things like that. And you can put your own screener in here. So, I'll put my earnings play screener, which basically is my own query, and I'll loop back to that into this screen here, and it will tell me, on Monday, we have these companies reporting. It'll tell you whether or not it's before the bell or after the bell, before and after the bell on Tuesday. Wednesday, what companies are there, Thursday, what companies are there. And when I'm in the market for playing earnings, I'll basically use this to figure out, okay, Monday I've got, IBM is after the bell. If I want to play IBM, I know I've got to put my trade on Monday. And that link to the calendar is super nice because it'll kind of show you what's up, what's coming. But the raw screening, which then doesn't actually order by the dates of the earnings, really what I'm looking at is, I look for something that has a stock price of greater than $10. I want the volatility to be at least 30%. I want the IV percentile really to be anything. I can kind of tweak this if there happens to be a lot. There's not that much coming up, so, this is kind of wide open. But basically, I'm looking for earnings in the next 5 days. And once I get this list, I'll basically sort by IV percentile. And when I play earnings, I want my IV percentile really to be above like 60%. I want that number super high, because that basically means that not only is the premium potentially high, it's as high, it's on the higher end for the last 52 weeks of trading. So if I look at here, one of the examples I want to show you is Snap. So, Snap has about a 48% IV rank. I know Snap has really good volume. I know their spreads are real nice. I've played Snap a lot in the options world. So this would be something that I would consider playing this coming week. And their earnings are on 4/22 after the bell. So let's go look and let's talk a little bit about what I look at for and what do all these things mean. So one of the things that Mike was mentioning was, if you can gauge, how much is the stock going to move? And while there's really no good way to know, you can at least understand what the market is saying. And so when you look at an option chain, a lot of the option chains, and all the brokers will have this, but in Thinkorswim, you're going to get this number here in the parentheses, and you'll get a plus minus 935. And this is basically saying, based on the options activity that's going on for options that expire on the week of April 23rd, it can be expected that from the beginning of the week to the close of the options, that the movement of the price is going to be plus or minus a little over $9. And you can kind of see, if you go out in time, hey, on the May 21st expiration, they're kind of right now, the options chain is indicating that the movement is going to be about $12.30 up or down. You don't really know which way it's going. So if I'm going to play Snap earnings, they announced this week. So I'm going to look at the option chain here on 23rd of April. And for me, you can decide whether or not you want to play bullish on this, whether you want to play bearish. But kind of as I indicated, it's really a coin flip. So a lot of times when I play earnings, I play a two-sided trade. Okay, I'm going to put a put spread on and a call spread. And a lot of my trades, when I do earnings, are usually around a 16 delta, which basically means, I get a 16 delta put and a 16 delta call, so that's about 32%. So it's about a 68% chance of probability of profit. But again, it's really a coin flip. So let's just put one of these up on the P&L graph. So 16 delta put, there really isn't one. So I'm going to err on the side of a little bit more conservative, and I'm going to take the 51 put, which is actually a 14 delta. And then I'm going to come down to the call side and look for about a 16 delta call. So it looks like 75 delta here. So I'm going to go ahead. So this right here is the strangle of the strikes that I put on there. And what you can see here is the expected, or at least one standard deviation move is right here. My break evens are out here, and this is going to collect about $178 in premium. Now, you might say, well, that's not very much. You have to remember that a lot of this premium is going to come out as soon as earnings are announced. And to give you an indication of about what that premium is going to deflate out of there, if we kind of look back here at the chain where you see, there's 154% here, what I tend to do is I look down, 2, 3, 4 months out, and what's the volatility in that? And it's about 60%, let's say. So I can kind of expect that this option here is probably going to drop down into the 50 to 60% as soon as earnings are announced. And if I come back to that P&L graph and I say, okay, well, what does this thing look like if we drop, 90 percentage points off of volatility? And watch the purple graph. So this basically means the value of the option. It instantly evaporates away. And you can see how cheap those options will become if that volatility drops, let's say it shaves 60% volatility off of there. Just an enormous amount of premium just deflates out of that thing. And so what I'm telling you this is when I go to play these, I'm putting them on the day before and I'm taking them off the day after. These are not a let it ride, get your 50%. This is a let's roll the dice. Let's see what we hit. We take profits the next day. Whatever we get, we get. If we lose, we lose. And this is exactly why, because you'll see a huge drop. Now, The one thing I would strongly recommend doing is when it comes to things like this, I would probably not play them naked. The reason for that is, you know, you never know what's going to happen. There have been several earnings plays that I thought, oh, you know, I'm more than double the expected move outside of the range. And sure enough, they announce earnings and they blow through my strike and I am deep in the money. And that's just not a good feeling. So what I would actually probably recommend doing is coming back to these strikes and then buying a protection leg off of each of these. So, you know, if I'm selling the 51, let's come out here and let's buy the 44. And let's go down here where we're selling the 75. And let's go ahead and buy the 81. Oh, that's not a very even leg. What did I do? I did my math wrong. Yeah, there we go. So now we have this defined risk. So you still are protected by your same bounds. You're giving up a little bit of your premium. So before we were collecting 178, here we're only collecting $105, but your max loss is going to be capped here. So in case this thing just goes to the moon or goes and crashes through Middle Earth, you're going to have protection on both sides. And if you still get, you know, your 60% drop in premium, you're still going to be able to cash this thing out if you don't get much movement here the following day. So that's how I would set up a trade for earnings. Do you have any feedback on Snap, Mike?
Yeah. So quite interesting, actually. Let's, like I mentioned, take a look at some levels for Snap. So here's a chart that I charted out. And if me saying charting levels is something new to you that you haven't heard of, hey, good news. We got an episode for you. Scroll on back to the episode about price levels, and that'll bring you up to speed. So I went ahead and charted out Snap, did my typical annual, monthly, and weekly level indicators. But currently, so what we're looking at here is the daily, and I just do that. I could chart the daily, but I'm comfortable with what I've charted, stopping at the weekly. But I still like to look at the daily just to see some of that, you know, interweekly movement, because it just gives a little more granularity about what's happening. So what I find interesting here is, and these numbers, these levels, I did not share these levels with Jeremy before he said everything he just said. And so and I also charted this before he said the numbers he just said. So what's interesting here is we go back, blue lines are my weeklies and the purple line there is a monthly. So we don't have any annuals at this level, but that's because Snap has been taking off for a while. So we don't really have this guy up here may become an annual, but we'll see. So for now we have weeklies and one monthly way up here at the top. So what's interesting is we have a pretty firm range of motion here, with this 47-ish being a pretty solid support level. It's been tested numerous times, and it's found the support it needed to jump back up off this level. It's found this, let's see, maybe 2, 3, 4 times between basically the month of December and January, this past December and January. Then we came up, we tested a new high, and it got up there to 73, and we came back down, and look at this crash, comes all the way down almost back to that 47, comes back up, and then we test again, and we get the support, and we get a nice strong bounce off of that. So currently, as of after hours today, Sunday, sitting at 61.25. So with the standard deviation Jeremy mentioned of 935, I believe it was, if granted, the price is not, the earnings aren't happening at this price. There's going to be trading that happens, but nonetheless, thought experiment. When you're setting up your play, you can look at the price now, just go through the motions, and then day of, go through the motions again. So 61.25, we go 9.35 down, and we're, pushing up on, this 47. There's a, factor of error. You don't know, it's not going to, just because you charted this doesn't mean it's going to respect it perfectly, but it will be in the ballpark. So that kind of brings us right down to this sink here, and this is, again, a very strong level. So playing your odds and all that, this is a very nice expectation of drop. And I believe that was exactly in the range. I think it was 51, in the range of what was selected there on the downside. On the upside, that's where things get a little. Well, let me finish that downside thought. So on the downside thought, the fun thing was that protection leg. You said 44, and 44.31 is a weekly level that I charted. So that makes perfect sense. The chart agrees. Price levels agree that, okay, this is a solid bounce support level here. Let's go ahead and place our play there. Let's put our protection at the next level down so we don't, like you said, get too screwed on a runaway down. So that checks out. On the upside, though, this is where things really, now you're really in literally uncharted territory. Once we get above this previous all-time high, somewhere around 73.70, which is, I believe you said somewhere around there was where you were placing the upper. That's decent to take the all-time high, because again, if it goes up, it would be hard to break the all-time high on nothing but earnings. It's not unheard of, but placing your protection leg is now, there's your data. Your data is just blank space. You got nothing. So then you really gotta watch yourself on your protection leg. That's going to be hard, because the thing about price levels and price action, when you break the all-time high, there is no grounds for where it's going to stop. It's going to stop, obviously, but there's no, I don't know the word I'm looking for, but there is no past indicator of where that's going to stop, because it's all new. So sticking to the deviation, sticking to a little above, for that protection leg makes sense. And I believe you were somewhere around 80, right?
Yeah, it was a 75 strike, and the protection leg, I said, well, put it at 80, make it a $5 wide.
So, and that makes sense, because if it breaks 80, it may not stop. It's going to find a new level, and so that is the risk when you're when you're making these earnings plays. When something is teasing with an all-time high, there is a risk to that ceiling. Consequently, there could be comfort in that ceiling, because, like I said, it's hard for a stock to run away on earnings. It might burst up, but by open, it might be back down. But this is an interesting one, certainly on the downside. If it runs away down, this is a very strong downside. So anyways, that is what the charts are telling me for Snap. I do like, I guess, previous earnings that I've watched or played. I do like I guess I lean on the comfort side when it's teasing all-time high, because it takes a lot to break a new level above all-time high. And usually earnings may not be it, but again, who knows?
Yeah, I got burned on Pinterest breaking new all-time highs several months ago, and that one hurt real bad.
So there you go.
Because I played that one naked. So let's take a look at another one here, just to give you a little bit more. So one of the other earnings that are coming up here is Netflix this week. They report on the 20th after the market closes. The one thing I want to call out here is the IV percentile is not very high. It's only about 18. So me personally, this isn't something I would play. But Netflix is a highly high-priced underlying, and the price of the underlying has a lot to do with the premium that is put into the options. So it still has about 43%, 44% volatility here. So let's go ahead and take a look at Netflix, because it's another option that's very popular to trade, has great liquidity, and real popular. So let me pull up and go over to our option chain here. And you can see, again, this week of earnings, we got about a 74% volatility. It's looking for about a $40 move up or down here from, looks like we're sitting at 546 on Netflix. And if you look out, in June, July, September, you can see that about 40% is mid 30s, upper 30s is really about where Netflix is sitting for volatility. So we can expect a pretty decent contraction of volatility here from 74%. Not as much as Snap, but a decent amount. So again, I'm going to pull up the option chain, and I'm probably going to start out with a 16 delta. And so this case, that's 502.50. For whatever reason, I'm real weird about strikes that are 50-cent strikes or things like that. There's really nothing wrong with them. I just don't like the way they look. So I'm going to go ahead and take the 500 strike here on the put side. And, that's about $46 down from where it is. And if you remember, we're looking for a plus minus $40 move. So, that's within there, which is usually where your 16 delta is going to work out to be. So let's come down to the call side. Because like I said, it's a coin flip. You don't know if it's going up. You don't know if it's going down. So might as well play both sides to collect a little bit more premium there than just trying to play one side. So if we come down to 16 delta here, it looks like we're looking at about a 600 strike. Now Netflix, again, is a pretty big underlying. So before I put this trade on, I'm probably going to go ahead and put protection legs in place for Netflix. So I'm probably going to look at about a $10 wide maybe. So let's buy a protection at 610, and let's come down here to 500, and let's put one in at 490. So you can see we gave up a good bit of our premium to buy that protection. Let me just put both of these trades on here so you can kind of compare and contrast them. All right, so playing this one naked, we're going to collect $770. And you can see that to buy those protection legs, we're giving up a considerable amount of our profit of credit received here to only collect about $2.34. But we are significantly reducing our risk. So you can see this one requires about $1,000 in margin. So, we're looking at about a 23% return. And if Netflix doesn't move at all, this is basically going to be overnight. It's not going to evaporate all, but, you're going to be able to pick up a couple percent overnight, chances are. Then if you actually look at the strangle here, you're going to put in $6,300 for, your 770. So it's about a 12% return on risk. So a little bit less of return there. But one thing I want to also point out, since we're kind of sitting here, and I mentioned, hey, we're always going to play them the week of. We're always going to take them the week of. The one thing that I have done before for, plays that I'm like, I really might want to extend the duration is I'll set the strikes based on the week of earnings, but then I'm going to take the expiration and bump it out to the nearest monthly. So this is something I've done before with some of the plays. I don't always recommend it because you can kind of get a little skewed based on how earnings come out. Typically, I might do this bump if I'm actually only playing one direction. But right here, if I bump this down to May and keep my protection legs, you're not going to get the huge volatility decrease because you're going out in time. You'll get some, but not much. But if you like these levels of your strikes, you can get a little bit more premium. Well, the premium is high right now. And kind of what Mike alluded to in the last trade that we looked at, it's really important to kind of do what I did here the day that you want to play the earnings, or the day you want to place the trade, because you're going to get trading between now and the day before their earnings. And so you're going to get a little bit of drift, up or down. And I always like, when I'm playing both sides of a trade, I like to center it up, just before the earnings kind of come out. So just keep that in mind, that, even if you look at this on, say, a Sunday, I'm going to keep these prices here such that, on the 19th or the 20th in this case, because they report after the bell. So I go to put this trade on the 20th, I'll recenter them, but I'll kind of use this as a starting gauge to say, hey, this is where it was on Sunday. How much have we shifted? How do I need to move my strikes around to play this before earnings? So that's just kind of some of the thoughts that I go through when it comes to earnings and Netflix. Mike, I don't know if you have any thoughts here on the Netflix chart or anything.
I sure do. Yeah, so let's take a look at Netflix here. Same thing we just did on Snap. Again, and to belabor the point, this is if you're going to gamble on, if you're going to gamble on earnings, like we said, anything's possible. Who knows what happens, blah, blah, blah. But these are the sorts of at least fundamental steps. I mean, in our opinion, if you think there's other things, by all means, let us know. Comments, Discord, that those are great places to have those discussions. Because as we've said before, we're certainly just learning along this way. But I feel very comfortable in these steps to establish these plays, what the analysis Jeremy just did. And then here, let's take a look over at the chart here for Netflix. This one is kind of wild. All the way back to last July, we established this level here around 470. And ever since July of last year, it has ping-ponged, semi-consistently between 470 and the all-time high, little peak up here, 592-ish, somewhere up there. So there is some similarity to what we just discussed on Snap. I mean, Snap was looking similarly, just under all-time high. So, but in that range as of today's prices, again, got to watch the price, got to watch the action leading up to earnings. Maybe it rips before earnings, and all of a sudden establishes a new all-time high. Who knows? But this is very interesting on this swing here, 470 to a peak of almost $600. But a consistent test, 1, 2, 3, 4, 5. We'll just call it 5, testing that 575 level. So there's a lot of resistance at that level. Remind me again what your put side was.
So I was looking at the 500 put for the strike, and I was going out to the 490 put for protection.
Yeah. So again, charted before he came up with that. Did not hear that number until you guys heard it. And here we have a 498.01 level as I charted it. Again, not exact, plus or minus in a move in an underlying this large. I mean, I'm comfortable with a plus or minus $5 on a level, maybe even 10. But nonetheless, we're right there on the put side. And this level hasn't had a lot of action. There was a lot of dip. So the 470 definitely gets more action on the support side. But recently, that's looking all the way back to July. I guess recently this level is getting some pretty decent support indicators, especially most recently where it hit it. Let's see, what was this? The week, I'm looking at dailies, March 25th, and then it ran back up to the highs where it likes there, but by April 12th. So that's a long run. So it is currently sitting at a known resistance level and after a big run up. So something to consider there. But 500 is definitely a solid put side, especially given recent history. The 490 protection, I mean, that'll definitely protect you. It might, I don't know. I mean, is there a premature protection, like where you know, would you see something like this and think maybe changing 470, or would you pretty much stick to that 490 to just give up if it goes across that?
It's really kind of depends on what your risk tolerance is. You'll get slightly bit more premium, and a lot of the Greeks will you'll be able to expose to them a lot more the wider you make those legs of the condor. I kind of refer back to my position sizing discussion that we had a few episodes ago, where really, that width of that strike determines your position size. And so depending on what your portfolio is and your risk tolerance, yeah, you could go wider. A $10 wide condor is probably about as narrow as you want to get for an underlying that's in the the 500s. You'll probably be a little bit better at maybe a 20 or 25 wide condor, but that will increase your max loss should you dive down there. So maybe combined with the chart analysis that you did and the individual's risk tolerance and where their thoughts are, absolutely you could make those wider, collect a little bit more premium, get a little bit more exposure to theta and stuff.
So very interesting couple plays and oddly symmetrical in how they, I mean, Netflix has a much larger history, which I think is pretty fascinating on these. These are not, these are large swings, 470 up to 600, but nonetheless, they're both currently priced just below all-time high, which makes them, we'll see, huge risk, huge comfort, who knows? But the key is land in the middle. That's the key to the whole thing.
Yeah, no doubt. Since you kind of mentioned a lot of the symmetrical and being on the one side of the trade being close to the all-time high, I want to show you a variation that I have been known to put on when it comes to earnings. And let me just show you that here real quick. So a lot of times I am really, really comfortable with naked puts. I think we've done a lot of episodes on the wheel, poor man's covered call. Really, when you have naked puts, yeah, you can go real low, but the worst case is you end up with the shares of stock. And so a lot of times when I want to get more premium out of a earnings play, I'll do what's known as a Jade Lizard, okay? And a Jade Lizard is basically a naked put, but on the call side, you add protection. So if we take Netflix here, I'll take my 500 naked put and the 600 call, and because I want to protect myself from blowing through the call side, I might, let's go ahead and do a 20 wide here and buy a protection at 620. And this right here is actually a Jade Lizard. And a lot of times when you do the Jade Lizard, you kind of want this, I don't know, call it lizard tongue, to be closer to your break even. So it's almost like a risk-free trade to the upside. And in order to do that, you usually bring in your put side closer. So instead of playing like a 500 put, I might come up to, I don't know, like a 540, right? And this is more of a bullish trade. But the key point that I want to call out here is whether or not you use the 500 to 540 doesn't really matter. You can layer on your protection just on one side of the trade, right? So if we're dancing near all-time highs and And who knows, Netflix might come out and announce they're merging with Disney Plus and Hulu and all the other streamings to make one monster streaming service. And this thing just goes to 800, right? You need to protect yourself on the upside because, in my opinion, there's nothing scarier than selling a naked call because you can get hurt pretty bad on that. And just adding this protection leg to the side that has that risk, you still pull in the premium from it, but you're capping your max risk here. And then the naked put, worst case scenario, you end up with 100 shares of Netflix here if it breaches below 500 by expiration. So that is the gist of playing earnings and what earnings plays look like, and how Mike and I kind of take an approach to earnings and where I play them when I play them. Like I said, earnings, they've been my biggest gains, and they've also been my biggest losses. And in general, these days, I don't really play earnings unless there's nothing else going on in the market. I'm more of a conservative. I like my monthly cycles that I've been churning through, so I can't say that I play very many earnings. I do keep an eye out for them. I look for the super elevated premiums that might be out there. But really, if you look at this coming week, there's some big names playing, but the amount of IV percentile in them is mediocre at best. And if I look back at the plays where I've really lost big on earnings, it's always when I've forced the earnings play. And when I say that is, I said, oh my gosh, I want to play every earnings this week. And I would play 30, 40 earnings trades in a week. And, some of those earnings trades were, at 15% IV or 20% IV. And sure, some of them were 70% and great like that. But I wanted to play as many as possible. And I was basically playing these lower IV percentiles, and that's just not a good plan. It's a recipe for getting bit, in my opinion. A lot of those trades, if you get volatility expansion in there, all of a sudden, it's expensive for you to buy back your options to close them out. And if the stock is trading at a very low historical IV compared to the past 52 months, the probability of volatility expansion is greater, right? Because there's always a reversion to the mean. So, just be sensible about it. Like, be careful about it. It's a ton of fun. I highly encourage you to try it sometime, see if you like it. And it's one of the more risky, let's call it, trades that I'll put on these days, as far as that goes. But just keep the things in your favor. Look for the really high IV percentile, get the strikes out there, and have fun with it. So good luck at earnings this week. They'll be going on for the next couple weeks. Keep an eye out. We'll call out something in the Discord if something looks interesting or something like that. This week I don't see much, but enjoy out there trading. Good luck to y'all. And remember to think outside the block.